So joining me now in the studio is Nash from FIIG Securities to take us through it. Stephen, welcome and thanks for your time. Obviously this is an issue which is kind of festering for the markets at the moment. What is actually the latest from where you're sitting on this crisis for Greece?
Well, the 10-year bond spread has gone out to over 400 basis points for Greek 10-year bonds. There's a perception there could be difficulties for the Greek government in refinancing its debt in May. It says that it's already refinanced for April, but there's about 11 billion euros they still have to finance in May.
And now the banks are going to the government to say that they need help. They're struggling, and we're hearing of reports of money just flowing out of Greece, flowing out of those banks.
Well, there has been some downgrades of Greek banks. There's a perception, I suppose, that Greece will have to tighten quite substantially fiscally, which may tip the Greek economy back into recession, and then there could be knock-on effects to the wider EU community as a result. Even
if it is cutting back with spending, it's, I guess, in some ways being outweighed by the fact that they've got these higher borrowing costs, though.
That's
it doesn't
right.
make an impact, really.
It doesn't. At the moment, the reduction in fiscal spending won't have much impact initially, but over time, definitely it will.
Do you think that the banks, are they facing a funding crisis? Are they likely to default? How serious is it?
I think the Greek banks will be fine. I think in terms of the Greek government, there's been a lot of speculation about the IMF and whether or not Greece will have to go back to the IMF. And the conditions from the IMF are quite rigorous. I imagine that there will be deals done, and the benefits from the broader union of the states are quite substantial. Obviously, at this stage, we've got some costs. You know, the other states will have to help Greece at this stage, but I think, as everyone knows, there's substantial benefits from the union continuing.
What's the impact on the markets and the implications for other economies as well, from the fact that we had a Greek rescue package suddenly thrown right back into doubt again, and people even questioning the size of the package altogether? Maybe it's just not enough.
I think the package that's been discussed is probably adequate for the Greek economy. The problem has been this recent scare in terms of the blowout of borrowing costs. At this stage, yes, it will be expensive for the Greeks to roll their debt, but it's not a perpetual thing. I mean, I imagine over time this borrowing cost will reduce, so that in the short term they're facing high borrowing costs, but over the medium term those should reduce substantially.
And what is the potential flow on to some of the other economies around that area?
Well, I think there's a renewed focus on borrowing costs for governments globally and fiscal problems that they've got. Ben Bernanke recently mentioned that with regard to the US, for example. So there's this focus that on governments that they have to rein in spending, and that's quite a big focus for financial markets broadly at the moment.
At the moment, there doesn't seem to be any shortage of buyers for US debt. Overnight, a 10-year auction, and that was fairly solid from what I understand. What's the latest commentary coming from the Fed Reserve, though?
Well, the Fed has said that the economy is doing quite well at this stage, but the inflation picture is quite subdued, and I think that's the really important thing to notice. People are saying that there is some change in the language, that this term extended period really doesn't refer to a particular period of time, but really relates to economic developments, and I think that's really no change at all. It's basically the same as it always had. But there's been a continuing emphasis on low inflation in the various releases, and I think the market's really not picking up on that.
Well, I suppose in the near term there is no inflation threat, it would seem. The markets really do have to balance that up against the fact that at some point down the line there will be that inflationary threat. Yeah. Is that being kind of... is the market waking up to that threat yet?
I think, you know, with 10-year yields at around 4% in the US, with very low inflation, you're offering quite attractive real yields. I think the market, to some extent, is coming to grips with the idea of an eventual tightening, and I think some people are going for a tightening mid-year, which I think is probably a bit early. It's probably an issue for 2011 in terms of a tightening, but the market's already well and truly built that in and has worried about that for the last 6 months.
Okay, and I should ask you about our own Reserve Bank as well. A lot of attention being focused on the RBA and its view on house prices here in Australia. You don't believe that the RBA is as obsessed about house prices as we might believe, though, as some commentators would suggest?
I think the RBA has been concerned about high levels in auction clearance rates and price rises in the housing sector. bubbles in the housing sector do tend to affect the financial stability of the economy broadly. So the RBA is concerned to some extent, but it's only one of the factors that they consider. They've been highlighting the fragility of the global recovery as well, and they have to balance this tendency in the global economy to underperform relative to expectations, whereas in the Australian economy we keep on outperforming. So the difference between the Australian economy and the global economy seems to be widening. So that makes it even more difficult for the RBA to decide on interest rates. However, the tightenings have had some effect on the housing market. It's just that they're probably not as strong as the RBA would like. They'd like to see some softening, some probably extended softening there.
It is interesting, though, in the latest minutes when they suggested, or the RBA suggested, that the fiscal worries had kind of stabilised a little bit, but then obviously that's a bit outdated now. Now we've got Greece back in the spotlight. Do you think that would have changed anything? What's the bond markets pricing in terms of further rate hikes?
In terms of further rate hikes in the Australian economy, we're looking for about 5% by the end of the year. There are some economists getting a little bit aggressive about rate hikes right now, calling for a period of successive rate hikes to send a message to the mortgage market. That's a possibility, but I imagine there'll be more pauses as we go through the year, just as the RBA assesses what's going on in the global economy.
Stephen Nash, we have to leave it there for today. Thank you so much. We appreciate your time.